We open today to a distinct cooling across the major indices. It's not a panic, it's calibration. The S&P 500, SPY, is down 0.36% to 687.85. The tech-heavy Nasdaq Composite Proxy, QQQ, is lagging, shedding 0.48% to 620.87. Small caps, ever the canary in the coal mine, show IWM off by 0.61%. This is textbook risk-off rebalancing after a significant run. The market is pausing to digest, and perhaps question, the trajectory. Look closely at the giants. NVDA, the engine of the AI boom, is pulling back 1.21%. TSLA is experiencing a significant digestion phase, down 3.27% today. Contrast this with the resilient Apple, AAPL, clinging to a marginal gain of 0.13%. Microsoft, MSFT, sits flat to negative at 487.10. The narrative remains, momentum leaders are finding gravity, while established staples are holding the line. The VIX, our fear gauge, is creeping up 1.69% to 14.44. Not an alarm bell, but the market is certainly demanding a higher premium for volatility protection today. Let's connect the dots. When the mega caps stutter, the system takes notice. We are seeing a structural shift in investor appetite, moving away from speculative growth toward perceived safety and defensiveness. When the markets are in flux, we turn to the people shaping the currents. Today, the VIP section is a geopolitical and corporate chessboard. First, the political noise. We have reports detailing Donald Trump's ongoing, volatile relationship with the Fed, suggesting he might sue Chairman Jerome Powell for gross incompetence. This level of institutional antagonism toward the central bank creates structural uncertainty that markets abhor. Furthermore, the news that New Year's Eve concerts at the Kennedy Center were cancelled, a minor social note, perhaps, but in the context of political climate volatility, these small signals matter to market sentiment. On the corporate front, the titans are defining the landscape. Jamie Dimon, CEO of JP Morgan, suggests that only one group is complaining about returning to the office. This implies a strong institutional push for structure and productivity, a bearish signal for remote-centric real estate plays, but bullish for established corporate centers. In the AI sphere, the race continues. Elon Musk is pushing the envelope with humanoid robots, noting China might lead the implementation, a geopolitical technology tilt we must monitor. Concurrently, Sam Altman is offering significant compensation, $555,000, for a crucial AI role, underscoring the intense, high-stakes human capital battle for AI dominance. And let's not forget Jensen Huang, recognized alongside Michelle Kang as a Person of the Year. The architects of the machine learning age are being celebrated precisely as their flagship stocks see minor corrections. Irony is standard fare in the market. We also see legendary wisdom resurfacing. Warren Buffett's timeless adage, "Be fearful when others are greedy," serves as a necessary counterbalance to the recent exuberance we've witnessed across speculative assets. Now, let's pivot to the bedrock of finance, the sovereign debt markets. This is where the real institutional money aggregates and where the future cost of capital is priced. The 10-year Treasury yield, the TNX, is moving lower, down 0.48% to 4.12%. This decline in yield is the market's primary way of signaling a potential deceleration in economic activity or an increased demand for safety. When equities sell off, capital flows into the perceived safety of U.S. Treasuries, pushing prices up and yields down. However, this move is contextualized by the macro environment. We are seeing inflation data suggesting stubbornness. For instance, the UK CPI data shows consumers remain reluctant to spend. In the Eurozone, Spanish inflation hitting 3% supports the ECB's case for holding rates steady. The critical interplay here is the potential divergence between slowing growth signals, lower yields, and persistent underlying inflation pressures. If this 4.12% yield continues to soften significantly, it implies the market is pricing in greater probability of a growth scare, which would put pressure on corporate earnings, especially in the high multiple tech sector we observed dipping today. Institutions are signaling caution through the duration markets. The Fed and its global counterparts are operating in a complex environment characterized by lagging inflation data and forward-looking growth expectations. We have fresh data points suggesting the path forward remains murky. Regarding the Fed, expert projections for 2026 suggest that even with anticipated rate cuts, mortgage rates may not plummet back to historical lows, indicating stickiness in the terminal rate environment or persistent structural demand-supply imbalances in housing. Meanwhile, Jerome Powell is facing political heat from the executive branch, which complicates the perception of Fed independence, a tangible risk premium for U.S. assets. Across the Atlantic, Christine Lagarde's ECB is observing peripheral strength, with Spanish inflation supporting a rate hold stance. This reinforces the global thesis: central banks are moving from aggressive tightening to prolonged holding patterns. The market is attempting to front-run when cuts will actually materialize. Currently, the bond market, lower yields, is betting on faster easing than perhaps the central banks are willing to signal overtly. This divergence is where intraday volatility originates. Commodities present a fascinating dichotomy today: soft power versus hard power. Gold, GC=F, is shining brightly, up 1.08% to $4,371.60. This is the classic hedge against geopolitical uncertainty and, more importantly in this context, against currency debasement and persistent inflation expectations that bonds are simultaneously signaling. Gold is the premium asset when confidence in fiat stability is tested. Crude oil, CL=F, is modestly up 0.17% at $58.18. This is relatively flat, indicating that the immediate demand shock is absent, but supply concerns persist. We have news of Woodside securing an LNG deal with Turkey's BOTAS, which shows the strategic realignment of energy infrastructure is ongoing. However, the low movement suggests the global economic slowdown narrative is capping oil's upside potential for now. A geographical flare-up, New Zealand faces a growing gas supply risk. This is a micro-level supply chain fragility that, if repeated across other jurisdictions, could introduce targeted energy cost inflation, irrespective of broad US CPI trends. Let's dissect the equity performance. The broad market decline suggests rotation out of recent winners and into relative safe harbors. Sector losers: the heavy underperformance is concentrated in high-growth technology, particularly EV and core AI infrastructure outside of the clear leader AAPL. Tesla, down 3.27%, is suffering from macro anxiety and continued competitive pressures, especially as Chinese competitors like Leapmotor announce aggressive sales targets, targeting 4 million units annually in a decade. Sector winners: relative, defense, utilities, and staples are likely absorbing the capital rotating out of tech. Apple, AAPL, stands out, up 0.13%. Its product stability and fortress balance sheet allow it to act as a de facto safe haven within the mega-cap cohort. We see targeted interest in energy plays. The headline regarding Vistra below $170 suggests speculative interest in energy infrastructure or specific producers based on market structure analysis, a name to watch as volatility shifts. And for those tracking the visionaries, Michael Burry's known bearish positions against Nvidia are now being publicly dissected. This shows the ongoing structural debate: is the AI growth narrative fully priced, or is this just a necessary correction? In the decentralized world, the narrative remains highly sensitive to traditional risk assets. Bitcoin is moving in tandem with the broader risk-off sentiment, though our dataset doesn't provide the exact 24 hours change for BTC, USD, we infer correlation. The debate rages on. Peter Schiff is vocal in his criticism of Michael Saylor, predicting Saylor's strategy will eventually run out of fuel. This is the institutional skepticism confronting digital asset adoption. Conversely, the movement of traditional capital into precious metals like gold suggests a persistent undercurrent of distrust in central bank management, which often spills over into the Bitcoin narrative. For now, crypto remains a high beta play on the global risk environment, correlating closely with QQQ but with amplified volatility. The mandate for today is prudence and selectivity. 1. Yield watch. We must monitor the 10-year Treasury, TNX. If it breaks decisively lower, below 4.00%, expect continued pressure on long-duration growth stocks. If it stabilizes or ticks up, risk assets may find their footing. 2. Tech consolidation. Will the pullback in NVDA and TSLA represent a buying opportunity for momentum traders, or the start of a deeper correction? Given the overall index weakness, expect sellers to maintain the advantage until key support levels are clearly defended. 3. Dollar strength. The dollar index, DXY, NYB, is flat at 97.99. A strengthening dollar, often associated with global growth fears, typically pressures commodities priced in USD. Keep an eye on USD equals X, which is barely moving at 1.18. Stability here suggests no immediate currency crisis, but vigilance is required. We are operating in an environment where the macro indicators, inflation stubbornness, slowing growth signals via the bond market, and political interference in monetary policy, are creating significant friction. The market is not crashing, it is deleveraging confidence in the frictionless upward trajectory we enjoyed in the immediate post-pandemic rally. The key lesson from the wisdom of the ages, Buffett's caution, must be heeded. Institutions are taking risk off the table. They are focusing on cash flow, stability, and political resilience. For the active trader, volatility is an opportunity, but blind momentum chasing is now a liability.